Hi guys, thanks for tuning in to another episode of Nugget News. We've got a special episode for you today. We're going to talk about the history of banks' debt and money and how it led to asset bubbles and inequality because the wealthy that own all those assets benefited. And we hear about this trickle-down economics where that money gets created into those banks and they should start businesses and lend and make its way into the real economy. But I'm going to outline how that clearly has not happened and where this is all going in the future. So this is usdebtclock.org. A lot of you will be familiar with this site. It has the total US national debt and all their other expenses, unfunded liabilities. We also have an Australian version of this for our Aussies that are interested in this, but it really shows you how quickly this debt is growing. And we're actually to the point now where we're struggling to even pay the interest on our debt in a lot of government's case. And we also have households that are heavily under debt. So this is why interest rates have had to drop so much to keep the economy going. But I'm going to get into all that in just a little bit. But I want to start off by talking about the business cycle. And there's different forces in the real economy, and it's perfectly natural to have this ebb and flow where we have underinvestment in a certain industry, and then it starts to get more popular, and we have overinvestment and prosperity, and then, there's too many people that invest and the bad businesses need to be flushed out, and the job sector needs to be reorganized with people working in the best, most efficient jobs and getting rid of the bad jobs. And that does lead to a little bit of a downturn or a depression, but this is all part of a healthy business cycle, and central banks have stepped in and tried to prevent this. So another representation here is, over time we're going up and to the right as prosperity generally increases and there's more money produced, there's more population, everything is expanding. Now, again, that has to change at some point because we do live on a finite planet, but GDP over time has generally been increasing. But what I'm worried about is that the central banks have stepped in every time we've had a bit of a contraction, and they haven't allowed for the trough and the bad businesses to be washed out. So rather than having a dip, they've sort of gone sideways until we have another big peak. And what that's created is a bubble or a situation where the natural trough or contraction is a lot lower. So we're actually up here instead of here now because they didn't let us have that first trough. And then we get that again and again, and we'll see this when we look at the charts. So we're up here somewhere, and the natural level of trough or contraction is down here. So when we do have a downturn or a fall, because they've taken us so far from reality or those natural equilibriums, the crash is likely to be a lot worse. So how did this all come about? Well, plenty of you have probably watched the same documentaries I have, and you know about the Bretton Woods system where we ended the peg to gold, where US dollars were redeemable for gold. And President Nixon said this was temporary, and then they sort of said, hey, this is all working really well. We can create as much money as we want, and nothing's really happening. And that's when the banking system and financial spending by governments, it all really changed. Now, some people would argue that the US dollar is still sort of backed by oil, and that's why we have all these wars in the Middle East, and that is a whole nother kettle of fish I don't want to get into today. But even that is changing at the moment with China settling some oil trades in yuan, or talk of gold and other currencies. So people looking to bypass the US dollar. I think longer term, yes, the US dollar is going to lose its place as that world reserve currency, with even Mark Carney, Bank of England, saying that now. So that's the first time we've really seen one of their friends rather than their foes being really vocal about how the US has had way too good a run. They get to create money and get all these assets, and it's just not fair for everyone else. So when we look at a long-term chart of gold, we can see the Bretton Woods Agreement clearly taking place here in 1971, where that peg to around $35 an ounce just went out the window. And people were worried about all this money creation, as they should be. And it did lead to a bit of inflation and people speculating on gold, with gold running to over $600 an ounce. Now, since that happened, there was a period of real prosperity where we had aggressive growth. You could get high interest rates on bonds. There was all sorts of reasons why you didn't necessarily need to own gold that had a 0% yield. I've done that video recently about bonds and yields and gold's place in the economy. So gold really, meandered, went sideways and bottomed out at around $250 an ounce in 2001 when we had that, that tech.com bubble. And central banks really stepped in for the first time there, lowering interest rates, and then after that, printing money after 2008. So the gold had this huge run up towards 2000. More recently, central banks promised us that everything will get back to normal with 3% growth and there's no need to own gold. And now, in the last few months, as we've been talking about for years, people are realizing that that is not the case. Central banks are going to have to keep rates at zero or negative. There's way too much debt. It can never be paid off, and people are turning to gold again. So let's have a look at this money printing, and particularly since 2008, where these central banks ramped up that printing press to buy different assets, mainly bonds. But in Japan, we've seen them buy ETFs. In Switzerland, they're buying stocks. So everything is going out the window in terms of what a real market is. If central banks are going to print money out of thin air and just buy up all these assets to keep the prices up, it really is unfair on the average guy on the street, because he doesn't own all these assets. And the rich know that they've got a backstop, that central banks are going to step in and buy everything off them. So there's never going to be a crash again in their mind. So look, pretty aggressive expansion there, $22 trillion. But you can see how this has to almost grow exponentially to prevent that downturn, that natural downturn. So if they didn't do this, how much lower would stock markets be is the real question. Now, in terms of total global debt, we're up to around $250 plus trillion now. These statistics are a little bit old, and we see households as well as financial corporations. Harvey Norman, in Australia just today at time of recording, announced they're going to be raising more money. A lot of companies are borrowing money just to pay out their dividends, to keep shareholders happy, or to buy back stock, to keep the share price high. There's no one investing, or there's nothing to invest in, because we've just mucked up this whole cycle. So hopefully you guys are starting to understand all these things I'm talking about, and you can really see how big the world of derivatives, because now nothing is pegged to real assets. We have derivatives of derivatives, and this market is in the quadrillions, over $1,000 trillion. Because of all the different speculation and leverage that are in financial markets. So look, a visual representation of that with all these piles and piles of cash compared to a truck down here, or I think, is that the White House or the Federal Reserve there? But it just shows you how much cash is in the real world in terms of those 9 biggest banks and their derivative exposure in the hundreds of trillions of dollars. So because there is all that debt, we've gone through that period of prosperity back here when there was really aggressive growth, and we had to really raise interest rates because there was so much money printing at will for the first time since we detached from the gold standard. Now, historically, for hundreds of years, interest rates have been around 5% because there should be a risk. If you're lending someone money, there's a bit of a risk there. You need to be paid for that risk. And if they're starting up a good business, it's going to grow quickly and they can pay down that debt. But that has all changed now that we've borrowed too much from the future. We've got these trillions or quadrillions of dollars outstanding with everyone leveraged and borrowing and betting on the future. And now they've had to drop interest rates to zero or negative because people and businesses aren't growing and expanding, and the economy isn't on that natural trajectory anymore. It's sort of time to pay the piper, you can think of that as, and people just aren't getting wage growth, and businesses aren't starting and growing, so there's no way to pay down all this debt. So that's why central banks are having to step in and fire up those printing presses to buy all sorts of assets. Now, the next slide here is prosperity, and how during that boom period, pay rose with productivity. So up until we had, gold loosely pegged to real world assets, and we didn't have these banks and governments being able to print all that money and then benefiting the rich, the average person was responsible and involved in a lot more of the business activity and prosperity. So you can see that the bottom fifth had 122% income gain, more than the top fifth, the top 20% of people. That's really crazy. Look, every bracket there in the lower class was prospering and growing their wages. But then as we went into this upside down world where the money goes into the banks and the corporations, well, guess what? The top 20% have really benefited. The top 1% of the 1% are the ones that have had the most benefit. And we see that the poorest, 20% have actually gone backwards, and all these other percentiles in the middle here are being left behind comparatively. So yeah, the hourly compensation and wages have gone up a tiny bit, but it's nothing compared to the amount of prosperity. You can call it that, but I don't necessarily think it is prosperity. But it's all gone to the upper class here. So there's a few different charts if you want to pause and have a read there. But I think that's a great example of what happened around that time the Bretton Woods agreement ended, and we detached money from gold and from reality, really. So this next chart just shows you those exact figures of historical long-term trends where a CEO was paid maybe 20 or 30 times more than the average worker. So obviously this is when that credit bubble and asset bubble started, as they're saying, around that time when the Bretton Woods Agreement ended and all that rampant expansion started. And guess what? CEOs now getting paid 360 times more than the average worker. Now, you can't tell me that any CEO, particularly these guys at banks that don't really do anything productive for the economy, they're sitting there with their nice shirts and at their keyboards all day, while we've got farmers out there in the real world, engineers, builders, these guys doing real jobs in manual labor that are getting way left behind, while these guys get paid 300 or more times what the average worker is. So look, each time we have a bit of a bubble, that does correct a bit because the rich lose a lot of their asset prices, but look, it's still ridiculous. Even 200 or 300 above the average worker there, it just shows that divide. So let's have a look at the long-term charts, and this is a 100-year chart of the Dow Jones Industrial Average, one of the biggest markets in the US. So each candle here represents 3 months. So I've identified my cycles that I love, and you can see that, sideways with cycles is fairly normal. And then we get to here, around that time when we ended the gold peg, and we had that time of sideways markets, and then we really just took off after around that 1980 point. You can see when money really started to expand. Now, we had that contraction around the dot-com bubble, but again, this was the first time when interest rates had been really aggressively dropped so that this didn't get worse. This could have corrected back to maybe this natural level here we'd been going sideways, and then we take off again. We then get into this other period here in the GFC where they stepped in and did all that money printing, and more recently, a lot of people were looking for a downturn even in the mid sort of 2010s here or more recently, but these just don't even register on a chart because of the central bank money printing and dropping interest rates negative. So maybe at this time here, we would have had a bigger correction from this cycle down to these natural levels, but you just don't know. But all that has gone out the window. So look, we can tell a similar story in Australia. Let's just have a quick look at the All Ordinaries. Let's put that on a monthly chart. And you can really see these cycles in Australia as well, these ebbs and flows over time. And more recently, Australia is just getting towards those all-time highs, whereas in the US and these other countries, well, particularly the US, because they have the reserve currency, they get to do the majority of money creation. Now, there's a lot of other reasons for this, but I certainly think that they've been the main beneficiary, and that does reflect through in these charts when you compare it to stock markets of other countries like Australia. So tying this all together, what does this mean and where is it going? Well, last night, I did a write-up for our members about unfunded liabilities and the pension funds, and you can see all these states in the US which are now losing 5 or 10% cash flows a year. They're being sucked out. There's more money coming out of them than going into them because we've got an aging population and all these retirees that are pulling money out of stock markets, pulling money out of their pension funds, and there's not enough workers, and there's not wage rises, there's not productivity, so those pension funds aren't growing, and government tax receipts. Hopefully that's all starting to make sense, and I know there's been some great videos out there by the guys at Real Vision and Harry Dent talking about this great unwind, this big deflationary event, the demographic cliff. Now, this is why when you look at this chart, I've got this pinned on Twitter, you look at the relative US dollar purchasing power, particularly recent years, it's just dwindled down to almost nothing when you compare it to real world assets. And that's why we're going to see gold and Bitcoin continue to grow because, comparatively, when all that money needs to be printed, to the tune of hundreds of trillions of dollars of unfunded liabilities for Medicare and Medicaid, to keep the stock market propped up, to buy all these bonds when investors turn for the doors, there's going to have to be so much money printed in the next downturn. I'm not sure if they're going to be able to drop interest rates to deeply negative. That's not going to be palatable. There's going to be, civil unrest, I think, at that point. But either way, we know that this is a mathematical certainty. They're going to have to print hundreds of trillions of dollars. This is why I am so bullish on Bitcoin. I've done my 3-part series about, maybe 20 years from now, we could reach $1 million. Maybe gold is going to $10,000 an ounce and silver a lot higher once all this money printing starts, because comparatively, the US dollar that it's all priced in is going to become worthless. And this is a similar story all over the globe where central banks are trying to devalue their currencies, trade wars, it's a race to the bottom. So guys, look, I've never been more bullish on Bitcoin. I know when I first got into it and started talking about it, I was really hopeful my long-term goal might be $3,000 of Bitcoin back in the day when Bitcoin was $10. But now I know more about market caps and how this all works. I really just think that this is getting started. So it's going to be a headache for central banks and governments. There's going to be some pushback, but I think long term, I'm very, very happy owning some gold, some silver, and some Bitcoin. So I hope you guys have enjoyed that one. Head over to nuggetsnews.com.au if you want to join our members area. Otherwise, smash that like button, subscribe if you haven't already, share these videos around, and thanks for tuning in, guys. Cheers.